There is a final promise an investor can make to themselves. It's not a promise of a certain return or a guarantee of a specific future. Those promises are fragile, easily broken by the chaotic whims of the market. This is a different kind of promise, a sturdier one, forged not from optimism, but from a profound and practical humility. It is a simple rule, a single sentence that, if followed with unwavering discipline, acts as an impenetrable shield against the greatest wealth-destroying manias of our time. It is the core principle that has allowed Warren Buffett to navigate 7 decades of market madness, not just surviving, but thriving amidst the wreckage of those who believed complexity was the same as genius. The rule is this: never invest in a business you cannot understand. If you cannot explain it, simply and clearly, to an intelligent 10-year-old, you have no business owning it. This isn't just a folksy piece of advice, it is a weaponized form of clarity. It is the ultimate filter, the bedrock of a risk management system so powerful that it has compounded capital at a rate that defies financial gravity. For the retail investor, for the aspiring entrepreneur, for anyone trying to build lasting wealth, this principle is the demarcation line between speculation and investment, between being a participant in a casino and being the owner of a business. To truly grasp its power, to internalize it so that it becomes an automatic reflex, we must deconstruct it. We must explore the stories behind its creation, the psychological traps it disarms, and the tangible financial results it produces. We will build this understanding layer by layer, through 5 distinct pillars, transforming a simple quote into an operational blueprint for financial freedom. We will begin with the foundation itself, the very concept that defines the boundaries of rational action in a world drowning in information, the circle of competence. The first pillar is the bedrock of it all, the circle of competence, the simple act of defining your own intellectual boundaries. This isn't about limiting your ambition, it's about concentrating your power. It is an admission, a wonderfully profitable admission, that you don't have to be an expert on everything. You only have to be an expert on the things you choose to own. Understanding this principle requires a trip back in time, to 1972, to a decision that would become a legend in the Berkshire Hathaway story, a decision involving not a revolutionary technology or a complex financial instrument, but something far more mundane and far more powerful: a box of chocolates. The company was See's Candies, a beloved West Coast institution. To the high-flying Wall Street analysts of the era, it was a joke. It was a boring, old-fashioned business in a world that was starting to fall in love with conglomerates and technology. But to Warren Buffett and his partner Charlie Munger, it was a masterpiece of simplicity. Blue Chip Stamps, a company they controlled, was presented with the opportunity to buy See's. The asking price was $30 million. The company was earning about $2 million after tax, meaning the sellers wanted a multiple of 15. By the quantitative deep value metrics that Buffett had learned from his mentor Benjamin Graham, the price was too high. Graham taught him to buy businesses for less than their liquidation value, to buy cigar butts off the ground with one good puff left in them. See's was no cigar butt. It was a premium brand asking a premium price. Buffett's initial reaction was to walk away. The numbers on the surface didn't fit his model. But Charlie Munger pushed him. Munger saw something deeper than just the numbers on the page. He saw a business they could understand with absolute, crystalline clarity. Think about the See's Candies business model. How does it make money? It uses high-quality ingredients to make chocolates and sells them through its own retail stores for a premium price. That's it. You could explain it to a child in 20 seconds. What is its competitive advantage? Its moat. It's a powerful brand built over generations, forged in the minds of millions of customers. When a husband in California needed to apologize to his wife, he bought See's. When a family celebrated a holiday, they bought See's. The brand was synonymous with quality and affection. This brand equity gave them pricing power. They could raise their prices a little bit each year to cover inflation and then some, and their loyal customers wouldn't even think of switching to a cheaper alternative. The experience, the nostalgia, the green and white box, it was all part of the product. The risks were equally understandable. What could hurt C's? A sudden shift in consumer tastes away from chocolate, a major decline in the quality of their product, or a scandal that damaged the brand's reputation. These were not complex technological risks. They were simple, human-scale business risks that Buffett and Munger could evaluate. They didn't need a PhD in physics or a deep understanding of software code. They needed to understand people, brands, and basic arithmetic. Buffett's initial hesitation was the vestige of his old, purely quantitative style. Munger's genius was in pushing him to pay a fair price for a wonderful business, rather than a wonderful price for a fair business, especially when that wonderful business was so profoundly understandable. They ultimately negotiated the price down to $25 million. That $25 million investment has since generated over $2 billion in pre-tax earnings for Berkshire Hathaway, earnings that didn't require a single dollar of additional capital investment from Omaha. It became the gusher of cash that funded countless other investments. C's Candies was the ultimate proof of concept. It was a business squarely within their circle of competence. They knew everything that mattered about it. They understood its economics, its customers, its brand. And because they understood it, they could hold it for decades, watching its value compound year after year, untroubled by recessions or market fads. The story isn't just about a great acquisition. It's a parable about the power of intellectual humility. It was Buffett's willingness to stick to what he knew, to operate where he had an edge, that allowed him to see the immense value in a simple candy company that Wall Street completely ignored. The psychological principle that makes the circle of competence so vital is a direct countermeasure to one of the most pervasive and dangerous cognitive biases, the Dunning-Kruger effect. Coined in 1999 by psychologists David Dunning and Justin Kruger, this effect describes a cognitive bias whereby people with low ability at a task overestimate their ability. It's the old adage that a little bit of knowledge is a dangerous thing. In no field is this more destructive than in investing. A novice investor opens a brokerage account, reads a few articles online, watches a cable news segment about a hot technology, and suddenly feels they have an informed opinion. They hear about a biotech company with a revolutionary Phase 2 trial for a new drug. They don't understand the mechanism of action, the statistical hurdles of Phase 3, the complexities of FDA approval, or the brutal landscape of pharmaceutical marketing. What they understand is the story. This drug could cure a major disease and the stock will go to the moon. They mistake their understanding of the simple, exciting narrative for an understanding of the complex, probabilistic business reality. This is Dunning-Kruger in its purest form. Their incompetence in the field of biotechnology prevents them from recognizing their own incompetence. Warren Buffett's rule is the ultimate antidote. The simple, brutal question, "Can I explain this to a 10-year-old?" forces an immediate and honest self-assessment. When that investor tries to explain the biotech company, they'll quickly descend into a fog of jargon they don't understand themselves. Well, it has this messenger RNA platform, and it targets specific proteins. The hesitation, the inability to simplify, is a blaring red light. It's the Dunning-Kruger alarm bell. It signals that you have ventured outside your circle of competence. You are no longer investing. You are gambling on someone else's expertise. You are substituting a good story for a deep understanding. Buffett, by contrast, operates with an almost paranoid level of intellectual humility. He has famously said that he and Munger have 3 boxes on their desk: in, out, and too hard. The too hard pile is by far the largest. The vast majority of businesses in the world, especially in rapidly changing fields like technology and pharmaceuticals, go straight into that pile without a second thought. He's not saying those businesses are bad. He's simply saying that he doesn't have a special insight into their long-term economics. He cannot predict with any degree of certainty what they will be earning in 10 or 20 years. And so, he passes. He is overriding the ego's desire to have an opinion on everything. He is consciously sidestepping the Dunning-Kruger effect by refusing to play in games where he can't clearly see the rules. This isn't a sign of a lack of intelligence, it's the very definition of wisdom. It is the recognition that the edge in investing comes not from knowing more than everyone else about everything, but from knowing what you know and, just as importantly, what you don't. So how does a regular person, a retail investor or an entrepreneur, looking to make smart capital allocation decisions, apply this principle in a practical, systematic way? The answer is a mental model we can call the 10-year-old explanation test. This is a step-by-step blueprint for building your own circle of competence. Step 1. Select a company you're interested in. Perhaps it's a brand you use every day, or a business you've heard good things about. Let's say it's a software company that provides cloud computing services. Step 2. On a blank piece of paper or in a new document, attempt to answer the question, how does this company make money? You must do this using only simple sentences, with no corporate jargon. Not, they leverage synergistic platforms to deliver scalable enterprise solutions, but rather, they own huge computer warehouses. Other companies pay them rent to store their data and run their websites on those computers. If you cannot make that simple translation, you have failed the test. The analysis stops here. Step 3. If you passed Step 2, now you must explain its primary, durable competitive advantage. What protects it from competitors? Again, use simple terms. For our cloud company, it might be, it would cost a new company hundreds of billions of dollars and many years to build as many computer warehouses as they have. So new competitors can't easily challenge them on price or scale. This is known as a scale-based moat. If your answer is something vague like, they have smart people, or they have good technology, that's not a durable advantage. That's a temporary edge. You have to be more specific. Step 4. Identify the biggest risks to the business, again in simple terms. A new, much cheaper way of storing data could be invented, or their biggest customers could decide to build their own computer warehouses instead of renting. Step 5. This is the crucial final step. Take your simple explanations and actually articulate them out loud. Explain the business to your spouse, a friend, or simply record a voice memo on your phone as if you were explaining it to a classroom of 5th graders. Listen to yourself. Do you sound confident and clear? Or do you find yourself stumbling, using filler words, and resorting to the jargon you were trying to avoid? The act of verbalizing forces a level of clarity that simply thinking about it does not. If you can't pass this final step with flying colors, you are outside your circle. You don't understand the business well enough to own it. This test is not about dumbing down your analysis. It's about achieving a level of understanding so profound that you can distill complexity into its essential simple truth. The genius isn't in understanding the complexity, it's in seeing the simplicity on the other side of it. Now, let's explore the antithesis, the path walked by the 99% of investors who lose money over the long run. This is the path of the hot tip chaser. This individual's investment process is driven entirely by external validation and social excitement. They aren't looking for businesses, they're looking for lottery tickets. The story often begins at a barbecue or in an online forum. A friend, glowing with recent success, talks about a new cannabis stock. They're cornering the market in a new derivative product. The stock is up 300% in 6 months, and it's just getting started. The hot tip chaser feels a powerful pang of envy and urgency, the dreaded fear of missing out. They go home, log into their brokerage account, and look up the ticker symbol. They see a chart that goes straight up and to the right. They don't download the annual report. They don't read the company's financial statements. They certainly don't apply the 10-year-old explanation test. If they tried, they wouldn't even know where to begin. What is the derivative product? How is it regulated? What are the margins? What are the costs of production? Who are the competitors? These are questions they don't even know to ask. Their entire due diligence consists of seeing a good story and a hot chart. So they buy. They put a significant chunk of their savings into the stock. For a week, it keeps going up, and they feel like a genius. They've discovered the secret to wealth management. But then, a news report comes out. A regulator has questioned the legality of the new product, or a larger competitor has announced its entry into the market. The stock drops 20% in a day. The hot tip chaser feels a surge of panic. Their conviction was never based on the underlying business, only on the rising stock price. Now that the price is falling, their entire thesis is shattered. They hold on, hoping for a bounce. But the bad news continues, and the stock bleeds out another 50% over the next few months. Finally, disgusted and terrified, they sell, locking in a massive loss. The disaster here is twofold. First, the financial loss is real and painful. But second, and more insidiously, they learn the wrong lesson. They conclude that the stock market is just a casino, or investing is too risky. The truth is, they weren't investing at all. They were blindly following a tip into a business they knew nothing about, operating hopelessly outside their circle of competence. The financial connection between strictly adhering to your circle of competence and your long-term portfolio growth is direct, tangible, and profound. Its primary impact is on the most important variable in the compounding equation, the avoidance of catastrophic loss. The math is unforgiving. A 50% loss requires a 100% gain just to get back to where you started. A 90% loss, common for speculative stocks after a bubble pops, requires a 900% gain to break even. By staying within your circle, you are dramatically reducing what Buffett calls stupidity risk, the risk of making an unforced error out of ignorance. Your portfolio, built with businesses you understand, becomes more robust. When a market panic occurs, like in March of 2020, and your stock in a simple consumer goods company drops 30%, you don't panic. You can reevaluate the business based on its fundamentals, which you understand. You can ask, are people going to stop drinking this soda or using this soap because of this crisis? If the answer is no, then the price drop isn't a signal of business failure, it's a sale. You can hold on confidently or even buy more. This dramatically lowers portfolio turnover. Lower turnover means fewer trading commissions and, more importantly, fewer taxes paid on capital gains, allowing your investments to compound more efficiently. Contrast this with the hot tip chasers portfolio. It's a chaotic collection of story stocks, constantly being bought and sold based on news and emotion. The turnover is high, the tax drag is significant, and the portfolio is incredibly fragile, susceptible to being wiped out by a single bubble bursting. On a balance sheet, a business you understand allows you to more accurately assess its assets, liabilities, and, most importantly, its future earnings power. This is the foundation of any sensible asset allocation strategy. You're not just buying a ticker symbol, you're allocating your capital to a stream of future cash flows that you can reasonably predict. This discipline, this commitment to staying within your circle, is what transforms investing from a gamble into a systematic process for achieving financial freedom. It is the first and most important promise you must make to yourself. The second pillar that supports this entire philosophy is the power of predictability. It's the conscious decision to choose the boring, reliable path over the exciting, uncertain one. In a world obsessed with disruption and exponential growth, Buffett's genius lies in his unwavering devotion to businesses whose futures are, to a large extent, already written. This isn't about a lack of imagination, it's about a deep understanding of probability. He would rather have a high chance of a good return than a low chance of a spectacular one. The quintessential story that illustrates this principle is his monumental investment in the Coca-Cola Company in 1988. This wasn't just another stock purchase. It was a defining moment for Berkshire Hathaway. Buffett invested over $1 billion, which at the time represented more than a quarter of his company's entire net worth, into a single stock. To many, this looked like a reckless bet, but to Buffett, it was the closest thing to a certainty he could find in the public markets. The context is crucial. The investment came on the heels of the Black Monday crash of October 1987, a day when the stock market plummeted more than 22% in a single session. Fear was rampant. Investors were terrified of another Great Depression. They were selling indiscriminately, dumping shares of great companies alongside the weak ones. While others saw chaos, Buffett saw opportunity. He had been a long-time admirer of Coca-Cola. He had seen its product everywhere he traveled in the world. He drank it himself every single day. But his analysis went far beyond his personal consumption habits. He studied the company's history. He saw a business that had survived 2 world wars, a Great Depression, and countless recessions. He saw a brand that was not just a product, but a piece of the cultural fabric in over 100 countries. The moat was immense and obvious. It was the brand itself, a mental monopoly lodged in the brains of billions of people. But the core of his investment thesis was its predictability. How did Coke make money? It sold syrup concentrate to bottlers all over the world. A simple, high-margin business. What were its growth prospects? He looked at the per capita consumption of Coke in the United States versus the rest of the world. He saw that international consumption was a tiny fraction of the American level. He didn't need a supercomputer to model the future. He just needed to ask a simple question. Is it likely that, over the next 10 or 20 years, people in places like China, India, and Brazil will drink more Coke? The answer was overwhelmingly yes. The business had a clear, simple, and powerful trajectory. The earnings were as predictable as the tides. He could calculate with a very high degree of confidence what Coca-Cola's earnings would likely be 5, 10, even 20 years into the future. The stock price in 1988 might have been volatile, bouncing around with the fearful sentiment of the market. But the underlying reality, the number of cans and bottles of Coke being consumed around the globe, was marching steadily upward, day after day, year after year. This gave him the conviction to make such a concentrated, massive bet. He wasn't gambling on a new technology or a complex merger. He was investing in the simple, predictable, and universal human thirst for a sweet, carbonated beverage. That $1 billion investment has since paid Berkshire billions upon billions in dividends and has grown in value to be worth well over $20 billion today. It is a monument to the unsexy, unheralded, and unbelievable power of predictability. The psychological principle at play here is a sophisticated inversion of a common bias known as ambiguity aversion. Behavioral economists have shown that, when given a choice, most people prefer to take a known risk over an unknown risk. For example, if you offer someone a choice between a bet with a 50% chance of winning $100 and a bet with an unknown chance of winning $100, most will choose the 50% bet. They dislike the ambiguity of the second option. Yet, in the stock market, many investors do the exact opposite. They are drawn to the allure of ambiguity. They will shun a boring blue-chip company that is highly likely to return 10% per year and instead pour their money into a pre-revenue disruptive tech startup. The startup has an ambiguous future. It could go bankrupt, or it could become the next Google, a 100x return. The sheer possibility of that massive, ambiguous outcome is more seductive to them than the high probability of a good, but not spectacular, outcome. This is a cognitive error. They are paying a premium for a story, for the thrill of the unknown. Warren Buffett brilliantly turns this on its head. He practices a form of investing that rigorously avoids ambiguity. He is not trying to find the next Amazon out of 1,000 speculative startups. He is trying to find the businesses where the future is the least ambiguous. He is actively seeking out the Coca-Colas, the See's Candies, the American Expresses of the world, companies whose competitive position and earnings power in 10 years look remarkably similar to their position today, only larger. By focusing on predictability, he harnesses the power of ambiguity aversion correctly. He is willing to accept the known, good return and let others chase the unknown, lottery ticket returns. This discipline protects him from the narrative-driven manias that so often engulf speculative sectors. While others are caught up in the exciting story of what a company could become, Buffett is focused on the boring, calculable reality of what a company conjures and what it is highly probable to continue being. This cerebral, almost detached approach to risk is a core component of his long-term success. He has weaponized boring. To apply this principle, you can use a powerful mental model called the Decade Ahead Newspaper Test. This is a thought experiment designed to force you to evaluate the long-term durability and predictability of a business. Here's how it works. Step 1. Take a company you are analyzing. Step 2. Imagine it is 10 years from today. You are sitting at your kitchen table reading the business section of the newspaper, or its digital equivalent. Step 3. Your task is to write the headline and a short, one-paragraph story about that company. The key is, you must be able to write this story with an extremely high degree of confidence. Let's try it with a company like Waste Management, a business that collects and disposes of garbage. The headline in 10 years might read, "Waste Management reports record tonnage as population growth continues. Price increases drive profit margins." The short story would be about how, due to its network of landfills, which are nearly impossible for competitors to replicate due to regulations, and its long-term municipal contracts, the company continued its slow, steady, and profitable growth. You can write that with a very high degree of confidence. Now try the same exercise with a young social media company. What will its headline be in 10 years? Will it be "Social App XYZ surpasses 3 billion users, dominates digital advertising"? Or will it be "Once hot social app XYZ sells for scrap as users flee to new platform"? It is impossible to say. The range of outcomes is enormous. The future is deeply, profoundly ambiguous. If you cannot write a confident, non-speculative, and reasonably positive headline for a company a decade from now, that business fails the predictability test. It belongs in the too hard pile. This mental model isn't about perfectly predicting the future. It's about filtering for businesses whose fundamental nature and competitive advantages are so strong that they are likely to endure and prosper across a wide range of possible futures. It is the ultimate litmus test for long-term investing. The antithesis to this disciplined approach is the disruption gambler. This is the investor who is pathologically addicted to the new. Their portfolio is a graveyard of yesterday's hot trends. In the late 90s, they bought internet infrastructure companies. In the mid-2000s, it was ethanol producers. In the 2010s, it was 3D printing stocks. More recently, it was speculative crypto assets and unprofitable software companies. Their guiding philosophy is that the only way to get rich is to catch the next paradigm shift before anyone else. They see predictability as a weakness, a sign of a company that is ripe for disruption. They mistake change for progress and volatility for opportunity. The fatal flaw in this strategy is that identifying a winning long-term trend is not the same as picking the winning company within that trend. For example, it was easy to predict in 1910 that the automobile would change the world. It was nearly impossible to pick which of the hundreds of car manufacturers at the time, Ford, Studebaker, Packard, etc., would survive and thrive over the next century. Most of them went bankrupt. The disruption gambler consistently overpays for a place at the table of a new trend, buying companies with exciting stories but no profits, no moats, and no clear path to long-term dominance. Their process is exhausting. They are constantly having to learn about new technologies and new industries, never developing a deep expertise in any single one. They are perpetually chasing narratives created by Wall Street and the media, which are designed to sell stocks, not to create wealth for the buyer. The result is a pattern of buying high during the peak of the hype cycle and selling low when the narrative inevitably fades and the lack of underlying business fundamentals becomes apparent. They are always on the hunt for the next 10-bagger, but their portfolio is slowly eroded by a series of 50 and 90% losses. They violate the most fundamental rule of compounding. They never let their capital sit still and work for them in a stable, predictable enterprise. The financial connection between a focus on predictability and superior portfolio growth is rooted in the mathematics of valuation. The theoretical value of any business is the sum of its future cash flows, discounted back to the present day. This is the bedrock of value investing, known as a discounted cash flow or DCF analysis. The key inputs into this model are the projections of future cash flow. For a predictable business like Coca-Cola or waste management, you can project those cash flows out 10 or 20 years, with a relatively narrow band of uncertainty. The business grows at a steady, single-digit rate. Its margins are stable. It requires minimal capital to grow. This allows you to arrive at a reasonably confident estimate of its intrinsic value. You can then compare that value to its current stock price and determine if it's a good investment. Now try to do a DCF analysis on a pre-profit biotech company. What will its cash flows be in 10 years? 0 or $1 billion? It's a guess. The range of possibilities is so wide that the valuation exercise becomes meaningless. You are not investing based on a conservative estimate of future cash flows. You are gambling on a single, low-probability outcome. Furthermore, predictable businesses are often cash-generating machines. Because they don't need to constantly reinvest every dollar they earn into speculative research or fighting off new competitors, they can return huge amounts of cash to their shareholders in the form of dividends and stock buybacks. These returns are tangible and real. They are the engine of long-term portfolio growth. A dividend check that you can reinvest is a concrete return, not a hope based on a rising stock price. Over decades, the slow, steady, and predictable accumulation of these cash returns, reinvested back into the business, is what builds generational wealth. This is the boring, methodical, and unstoppable math that underpins the entire Buffett philosophy. The third pillar is the role of this principle as the ultimate defense against hype. In the manic phases of a market cycle, when logic is suspended and greed reigns supreme, the simple question, "Do I understand this?" becomes a psychological fortress. It is the circuit breaker that protects your capital from the emotional contagion of a bubble. To truly appreciate this, we must revisit what is perhaps the most famous and difficult period of Warren Buffett's career, his steadfast refusal to participate in the dot-com bubble of the late 1990s. It is difficult to overstate the pressure he was under. The world was changing. The internet was going to revolutionize everything. A new paradigm of valuation was born, where old metrics like profits and cash flow were deemed irrelevant. All that mattered was, quote, eyeballs, network effects, and first-mover advantage. Companies with no revenue, let alone profits, were coming to the public market and seeing their stock prices double, triple, or even rise tenfold in a matter of months. Meanwhile, Warren Buffett and Berkshire Hathaway were sitting on the sidelines. Their portfolio, filled with old economy stocks like insurance companies, consumer brands, and utilities, was dramatically underperforming the red-hot NASDAQ index. The media turned on him. Barron's published a now infamous cover story in 1999 titled "Warren, What's Wrong?" The article suggested that he was a relic, a dinosaur whose folksy, value-based approach was hopelessly out of touch in the new digital age. Younger, tech-focused fund managers were hailed as the new geniuses. Buffett was openly mocked for being too old, too slow, and too stubborn to understand the future. Through all of this ridicule and underperformance, Buffett remained completely unflappable. His response was consistent and simple. At his annual meetings and in interviews, he would calmly state that he didn't invest in the dot-com stocks for a very straightforward reason: he didn't understand them. He couldn't, with any degree of certainty, predict what the competitive landscape for these internet companies would look like in 10 years. He couldn't look at a company like Pets.com or Webvan and project their earnings and cash flows. He saw hundreds of companies competing in the same space, all losing money, all funded by a seemingly endless supply of venture capital and public market enthusiasm. He knew the internet was a transformative technology. He compared it to the automobile and the airplane. But he also knew that those earlier technological revolutions had been terrible for investors. Most car and airplane manufacturers had gone bankrupt. He saw no reason why the internet would be any different. He was willing to endure the short-term pain of looking foolish in order to avoid the long-term certainty of permanent capital loss. And then, in March of 2000, the bubble burst. The Nasdaq index, which had peaked above 5,000, began a brutal two-year collapse that would see it fall by nearly 80%. The high-flying dot-com darlings were wiped out. Pets.com, which had run a Super Bowl ad just months earlier, went bankrupt. Cisco Systems, a profitable and real company that was the darling of the era, saw its stock fall by more than 85%. Billions of dollars in speculative wealth vanished into thin air, and Warren Buffett, the dinosaur, was vindicated. His discipline, his refusal to stray from his circle of competence, had protected his shareholders' capital from one of the greatest market manias in history. He hadn't just survived, he was now holding a mountain of cash, ready to provide liquidity to a desperate market. His stand during the dot-com bubble is the ultimate testament to his philosophy. It is a masterclass in risk management, proving that in investing, the game is often won not by making brilliant moves but by consistently avoiding stupid ones. The psychological forces at work during a market bubble are immensely powerful, and Buffett's rule is designed to counteract the most potent of them all: social proof and herd behavior. Human beings are social creatures. We are hardwired to look to others for cues on how to behave, especially in situations of uncertainty. When we see everyone around us doing something and succeeding, our brain tells us that it must be the right thing to do. In a financial bubble, this instinct runs rampant. Your neighbor, your coworker, the person on the news, everyone seems to be getting rich buying a certain type of asset. The feeling of being left behind, the fear of missing out, FOMO, becomes an almost unbearable psychological burden. It starts to feel riskier to not participate than to join the herd. Logic goes out the window. The rising prices become their own justification. People buy because the price is going up, which causes the price to go up further, which draws in more buyers. It's a self-reinforcing feedback loop of collective delusion. The principle of only investing in what you understand acts as a powerful brake on this emotional stampede. When presented with the hot dot-com stock, the rule forces you to stop and ask a series of individual, rational questions. How does this business make money? What is its competitive advantage? What are its risks? The very act of asking these questions separates you from the herd. The herd is not asking questions, it is acting on emotion. Your inquiry forces a shift from the emotional limbic part of your brain to the analytical, prefrontal cortex. You are no longer just reacting to social cues, you are engaging in an independent analysis. Most of the time, with bubble-era stocks, you will quickly discover that you cannot answer those questions in a satisfactory way. You can't explain the business model simply because it doesn't have a viable one. You can't identify a durable competitive advantage because there isn't one. This realization that you don't understand it gives you the intellectual and emotional permission to not participate. It reframes the decision. You are not missing out. You are intelligently abstaining from a gamble you don't understand. It is a shield of rationality that protects you from the madness of the crowd. To build this shield into your own investment practice, you can use a mental model called the "explain the moat, not the story" framework. This is a simple but incredibly effective technique for filtering out hype. Here's the process. Step 1. The next time you hear a compelling pitch for a hot stock from a friend on social media or on television, consciously ignore the narrative. Tune out the exciting story about how it's changing the world or disrupting an entire industry. These stories are designed to appeal to your emotions. Step 2. Force yourself to articulate, in a single, simple sentence, the company's durable competitive advantage or its moat. What specific structural characteristic protects this business from competition and allows it to earn high returns on capital over the long term? There are only a few major types of moats. Is it a powerful brand, like Coca-Cola's? Is it a network effect, where the service becomes more valuable as more people use it, like a credit card network? Is it a low-cost advantage driven by economies of scale, like a massive retailer? Is it high switching costs, where it's a huge pain for customers to leave, like the software that runs a company's core operations? Or is it a government-granted advantage, like a patent or a license? Step 3. If you cannot clearly and confidently identify and explain the moat in one of these categories, then you are not investing in a business, you are buying a story. A story can make a stock price go up for a while, but only a moat can sustain a business's profitability for decades. This framework is a hype detection system. Bubble stocks are almost always all story and no moat. They have a grand vision for the future but no tangible, structural advantage in the present. By focusing ruthlessly on the moat, you can cut through the noise and evaluate the business on its actual long-term prospects, not its short-term popularity. This is how you avoid becoming the last buyer at the top of a mania. The antithesis of this disciplined approach is the late-cycle speculator. This person represents the tragic final phase of every market bubble. They are not the early adopters or the true believers. They are the skeptics who, after months or even years of resistance, finally succumb to the social pressure and FOMO. They have watched their more adventurous friends and neighbors seemingly print money. They have grown tired of feeling prudent but poor. Their resolve finally breaks. They capitulate and buy in, often near the absolute peak of the market. Their purchase is not an act of analysis. It is an act of emotional exhaustion. They have no understanding of what they are buying. They couldn't explain the business model or the moat if their life depended on it. All they know is that it has been going up, and they want their share. The psychological journey of the late-cycle speculator is brutal. There is a moment of initial euphoria after they buy. They feel relief, a sense of belonging. They are finally part of the party, but this feeling is quickly replaced by a gnawing anxiety. Because their conviction is non-existent, every small dip in the price is terrifying. When the bubble finally and inevitably pops and the stock begins its precipitous fall, they are psychologically unprepared. They have no tools to evaluate the situation. Their only data point, the rising price, has reversed. They tell themselves it's a temporary dip, a buying opportunity they heard others talk about. But as the losses mount from 10% to 30 to 50%, their fear turns into raw panic. They sell, usually near the bottom, locking in a devastating loss. The financial damage is immense, but the emotional scar is even worse. They often swear off the market entirely, convinced it is a rigged game, forever missing out on the legitimate, long-term wealth creation that a sensible investment strategy provides. They are the human cost of hype, the predictable victims of every mania, all because they strayed from the simple principle of investing only in what they could understand. The direct financial connection between this principle and wealth preservation is the concept of avoiding permanent capital impairment. This is the single most important rule in Buffett's playbook. Rule number 1, never lose money. Rule number 2, never forget rule number 1. He's not talking about a stock going down 10% in a month. He's talking about a permanent loss of capital, where you invest in a business that fundamentally fails, and your investment goes to or near zero. Surviving a bubble you don't understand is the key to avoiding this fate. Let's quantify it. A single 50% loss in a portfolio requires the remaining capital to generate a 100% return just to get back to the starting point. The mathematics of compounding is powerful on the way up, but it is absolutely devastating on the way down. The primary financial benefit of sitting out the dot-com bubble was not that Buffett made a lot of money between 2000 and 2002. It was that he didn't lose 50 to 80% of his capital like so many others did. By preserving his capital base during the bust, he kept his compounding machine intact. This allowed him to continue growing his wealth off a much larger base in the subsequent years. This is the essence of high-level risk management. It's not about avoiding all volatility. It's about avoiding the kind of catastrophic risk that can knock you out of the game permanently. On a practical level for a retail investor, this means your asset allocation can be more aggressive in the areas you do choose understand, because you have eliminated the single greatest threat to your portfolio: the risk of being wiped out by a popular delusion. By staying within your circle of competence, you are not just managing risk, you are preserving the very fuel of your long-term financial freedom, your capital. This discipline is what separates the fleeting speculator from the enduring investor. The fourth pillar reveals how this principle transforms your entire relationship with market volatility, turning it from a source of terror into a source of opportunity. This is the confidence to hold. When you truly understand the businesses you own, a falling stock price ceases to be a threat and instead becomes an invitation to increase your ownership at a more attractive price. The story that best exemplifies this is one from early in Buffett's career, a trial by fire that forged his understanding of the difference between a company's stock price and its underlying value. The year was 1963, and the company was American Express. At the time, American Express was considered one of the most pristine, blue-chip stocks on the market. But a disaster struck. One of their major clients in their warehousing division, a company called Allied Crude Vegetable Oil, was discovered to be a massive fraud. The company had been borrowing huge sums of money against its inventory of salad oil, which was held in American Express's warehouses. When the fraud was uncovered, it turned out the tanks were mostly filled with seawater. Allied defaulted, and American Express was on the hook for millions of dollars in losses, a huge sum at the time. The market panicked. Wall Street feared that the scandal would bankrupt American Express, or at the very least, tarnish its reputation so badly that its core businesses, the travelers' checks and credit cards, would collapse. The stock was crushed, falling by nearly 50%. Investors, driven by fear and uncertainty, were dumping their shares at any price. But Warren Buffett didn't look at the stock ticker. He did something radical. He went out to investigate the actual business. He visited restaurants and banks. He talked to merchants. He would go to a restaurant and pay with an American Express card, and then watch to see if the cashier at the next table would still readily accept one from another customer. He would go to a bank and ask to exchange his American Express traveler's checks for a competing brand, and the banker would look at him like he was crazy. What he discovered was that the panic on Wall Street had no connection to the reality on Main Street. The salad oil scandal was a fire in one small, isolated division of the company. But the core business, the powerful moat built on the trust and convenience of its cards and checks, was completely unharmed. Customers were still using the products. Merchants were still accepting them. The franchise was intact. He realized that the market was confusing a one-time, quantifiable loss in a subsidiary with a mortal wound to the entire enterprise. Because he understood the real source of American Express's value, the brand and the payment network in the minds of its users, he could see that the 50% price drop was not a reason to sell, but a once-in-a-lifetime opportunity to buy. He invested 40% of his partnership's capital into American Express stock. As the company absorbed the salad oil losses and its powerful core business continued to churn out profits, the market's fears subsided and the stock price soared. The investment was a grand slam, cementing his reputation and making a fortune for his partners. He was only able to make this incredibly bold, contrarian move because he had stepped outside the noise of the market and done the work to understand the fundamental reality of the business. The psychological principle that this confidence overrides is one OFR, the most powerful and primitive biases we have, loss aversion. Pioneering work by psychologists Daniel Kahneman and Amos Tversky showed that humans feel the pain of a loss approximately twice as strongly as they feel the pleasure of an equivalent gain. Losing $100 feels as bad as winning $200 feels good. This is an evolutionary defense mechanism. In a world of scarcity, losing your food supply was a far more significant event than finding some extra. In the stock market, this bias is a portfolio killer. When a stock you own starts to fall, loss aversion kicks in with overwhelming force. The red numbers on the screen trigger a visceral, emotional pain response. Your brain screams, "Sell! Make the pain stop! Protect what you have left!" If you don't have a deep understanding of the underlying business, the falling stock price is your only source of information, and that information is telling you that you made a terrible mistake. You are flying blind in a storm, and your emotions are your only guide. However, if you have done the work, if you've operated within your circle of competence, you have a second, independent, and far more reliable source of information: your knowledge of the business itself. You can compare the market's panicked reaction to your own rational assessment of the company's long-term prospects. You can see that the fear is disconnected from the fundamentals, just as Buffett did with American Express. This deep understanding acts as an emotional anchor. It allows you to override the primal scream of loss aversion. It gives you the capacity to remain calm, to think rationally, and to even take advantage of the market's folly. Without that anchor of understanding, you are at the mercy of your most primitive fears, and you will almost certainly end up selling at the worst possible time. To cultivate this fortitude, you can employ a mental model called the business owner's mindset drill. This is a powerful reframing exercise to use during any market downturn. Here's how it works. Step 1. The next time one of your major holdings drops significantly, say 20% or more, your first move should be to completely ignore the stock ticker and the financial news for 24 hours. Do not marinate in the negativity. Step 2. During this time, engage in this specific thought experiment. Ask yourself, if I owned 100% of this company as a private business, if it were my family's corner store or factory, and a broker called me today and offered to sell me an identical business right across the street for 20% less than I thought mine was worth yesterday, how would I feel? Step 3. If the long-term earnings power of the business has not fundamentally changed, your answer should be that you would be thrilled. You would be scrambling to find the money to buy the second business at a discount. You would see it as a massive opportunity, not a terrifying crisis. This drill forces you to mentally separate the business from its stock price. It shifts your perspective from that of a nervous stock renter to that of a confident business owner. You can only perform this drill successfully if you actually understand the business well enough to make an independent judgment about its long-term earnings power. If you don't, the question is meaningless, and you will inevitably revert to staring at the falling stock price. Adopting the business owner's mindset is the key to turning volatility from an enemy that causes you to sell low into an ally that allows you to buy low, dramatically enhancing your long-term returns. The antithesis of this is the price's truth follower. This investor has outsourced their thinking entirely to the stock market. They have no independent conviction because they have no independent understanding. To them, the market is an all-knowing oracle. The stock price is not just an indicator of value. It is the value. Their entire emotional state is yoked to the daily fluctuations of the ticker tape. When the price of their stock is going up, they feel brilliant and validated. They talk about the company's great prospects, often parroting lines they read in an analyst report or a news article. They believe the company is good because its price is rising. When the stock price inevitably turns and begins to fall, their entire worldview collapses. The company must now be bad. They don't have a reservoir of deep business knowledge to draw upon. They can't perform the business owner's mindset drill. All they know is that the oracle, the market, has changed its mind, and they must follow suit. They are the personification of Mr. Market, the manic-depressive business partner that Benjamin Graham imagined in his writings. They are euphoric at the top and despondent at the bottom. They are constantly being whipsawed by market sentiment, buying after a big run-up and selling after a painful decline. Their portfolio is a testament to the old adage of buy high, sell low. They lack the one thing that could save them: an independent framework for valuation based on a genuine understanding of the business. A framework that allows them to tell Mr. Market when he is being a fool. The financial connection between the confidence to hold and buy more during downturns and exceptional portfolio growth is where the truly transformative wealth is created. This is what separates average investors from the greats. Market downturns are not a rare occurrence. They are a regular and unavoidable feature of the investing landscape. For the investor who doesn't understand their holdings, these downturns are periodic wealth-destroying events. For the investor who does understand their holdings, they are periodic wealth-creating opportunities. Look at Buffett's actions during the 2008 financial crisis. While the world was melting down, he was a calm and rational provider of capital. He made multi-billion-dollar investments in bastions of American capitalism like Goldman Sachs and Bank of America when they were on their knees, negotiating incredibly favorable terms because he had capital and conviction when no one else did. He could do this because he understood the banking business. He knew that, while they were in a period of extreme distress, these institutions were essential to the functioning of the economy and were almost certain to survive and prosper in the long run. These crisis-era investments were among the most profitable of his entire career. This directly impacts your long-term compounded annual growth rate, CAGR. Every time you are able to add to your best ideas at prices that are 20, 30, or 50% below their intrinsic value, you are dramatically pulling forward your future returns. You are not just earning the normal return of the business. You are earning that return, plus the extra return from the closing of the gap between the panic price and the fair value. This is the active, opportunistic component of value investing, and it is a financial superpower available only to those who have done the hard work of truly understanding what they own. The fifth and final pillar elevates this principle from a simple investment tactic into a grander philosophy for business and for life. It is the realization that simplicity is the ultimate sophistication. In a world that increasingly rewards and fetishizes complexity, the commitment to the understandable is a radical act of clarity and focus. It is about building not just an anti-fragile portfolio, but an anti-fragile life. The perfect story to capture this ethos is not about a massive public company, but about a small, family-run business and the diminutive, indomitable woman who built it, Rose Blumkin, better known as Mrs. B, the founder of the Nebraska Furniture Mart. Mrs. B was a Russian immigrant who arrived in America unable to read or write English. In 1937, with a borrowed $500, she started a furniture business in the basement of her husband's pawn shop in Omaha, Nebraska. Her business strategy was brutally simple and could be summarized in two commands: sell cheap and tell the truth. She worked tirelessly, buying directly from manufacturers to cut out middlemen, maintaining Spartan overhead, and passing those savings on to her customers. She built a local empire on a foundation of trust and unbeatable prices. In 1983, Warren Buffett, a longtime customer and admirer, decided to buy the business for Berkshire Hathaway. The negotiation was legendary. He went to see the then 89-year-old Mrs. B. He asked her what the price was. She told him. He asked if she would show him the financials. She said they didn't really have them. He thought for a moment and then said, "I'll take it." He bought 90% of the Nebraska Furniture Mart, which by then was the largest home furnishing store in the country, for $60 million, without auditing her inventory or checking her receivables. The deal was done on a handshake. Why would a meticulous, detail-oriented investor like Buffett do such a thing? Because the business was the epitome of simplicity and integrity. He understood it instantly and completely. He didn't need to analyze complex supply chains or opaque financial derivatives. The business was Mrs. B. Her character, her work ethic, and her simple, powerful business model ton the business. He understood that her moat was not some proprietary technology, but the ferocious loyalty she had earned from her customers over 5 decades of honest dealing. He knew what the business would be doing in 10 and 20 years. The exact same thing. Selling furniture honestly at the lowest possible price. After he bought the company, he sent his friend, the CEO of another Berkshire subsidiary, to Omaha to learn from Mrs. B. The CEO returned and told Buffett, "I'd rather wrestle a grizzly bear than compete with that woman." The story of Mrs. B and the Nebraska Furniture Mart is a profound lesson. It shows that the most powerful business models are often the simplest. They are rooted in basic human needs and timeless virtues like trust, value, and service. Buffett's ability to recognize the genius in this simplicity, to value it more highly than the superficial sophistication of a complex but fragile enterprise, is a core reason for his success. He seeks out businesses run by people he can trust, with models he can understand, serving needs that will endure. It is a philosophy that strips away all the non-essentials and focuses only on what truly matters. The underlying psychological principle here is the management of cognitive load and decision fatigue. Our brains are not supercomputers. We have a finite amount of processing power and a limited daily budget of high-quality decision-making energy. Every complex problem we tackle, every new piece of jargon we have to learn, Every uncertain variable we have to weigh drains that budget. This is cognitive load. When that load becomes too heavy for too long, we experience decision fatigue. Our ability to make rational, patient, long-term choices degrades. We become more impulsive, more likely to make mistakes, and more susceptible to simple, emotional arguments. The modern financial world is an engine for generating maximum cognitive load. An investor is bombarded with thousands of stocks, complex economic data, geopolitical news, and an endless stream of analyst opinions. Trying to master all of it, or even a small fraction of it, is a recipe for burnout and poor decision-making. Buffett's philosophy of simplicity is a brilliant system for managing this cognitive load. By defining a narrow circle of competence and focusing only on simple, predictable businesses, he drastically reduces the number of variables he needs to track. He doesn't need to have an opinion on the future of cryptocurrency, the nuances of biotech regulation, or the competitive dynamics of the semiconductor industry. He can happily and unapologetically ignore 99% of the investment universe. This frees up immense mental bandwidth. It allows him to think more deeply and clearly about the few businesses he does choose to focus on. He can study their histories, their management, their competitive positions, with a level of detail that is impossible for the hyperactive generalist. This is a form of mental arbitrage. He is winning, not by being smarter in a complex game, but by choosing to play a simpler game that he knows he can win. The practical application of this principle, the mental model for simplifying your own financial and professional life, is what Buffett calls the too-hard-pile system. It's a beautifully simple but profoundly effective filter for decision-making, applicable to entrepreneurs, executives, and investors alike. Step 1. Imagine you have 3 physical or metaphorical trays on your desk: an in pile, an out pile, and a too-hard pile. Every potential investment, business opportunity, or major decision that comes across your desk must first be subjected to a single question: is this an easy, understandable problem for me? Step 2. If the opportunity involves a technology you don't fundamentally grasp, a business model with too many moving parts, a financial structure that is convoluted, or an outcome that depends on factors you cannot reasonably forecast, you must resist the urge to figure it out. Your ego will want to prove you are smart enough to solve the puzzle. You must override this. Step 3. Immediately and without guilt, place that opportunity in the too-hard pile and move on to the next item in your in pile. The goal of this system is not to solve every problem that comes your way. The goal is to efficiently find the handful of easy problems where you have a significant advantage. Charlie Munger describes it this way: we have 3 baskets for investing: yes, no, and too tough to understand. And they look for the yes decisions that are no-brainers. If a decision requires a 170-page spreadsheet and complex calculus to justify, it's not a no-brainer. It belongs in the too-hard pile. This system preserves your most valuable asset, your mental energy. It allows you to focus your attention on the small number of opportunities that can deliver extraordinary results with low risk, simply because you understand them better than almost anyone else. It is the ultimate productivity hack for strategic decision-making. The antithesis to this philosophy is the individual who suffers from complexity bias. This is the person who instinctively equates complexity with sophistication. They are drawn to intricate investment strategies, believing that a simple approach must be a naive one. They are the ones who try to use complex option strategies they don't fully understand, who invest in hedge funds with black box trading algorithms, or who prefer to invest in a company with a sprawling, incomprehensible 10K report over one with a simple, clear business model. They believe that if an answer is simple, it can't possibly be right for a complex world. This bias is deeply rooted in our desire to feel intelligent and in control. A complex strategy feels more powerful, more exclusive. It offers the illusion of a secret knowledge that others don't possess. The financial industry is built on catering to this bias, creating ever more complex products that serve to generate fees for the provider, not returns for the client. The complexity bias sufferer is the perfect customer for these products. They fail to realize that in investing and in business, Added complexity often just means more ways for things to go wrong. A simple business model is more robust. It has fewer critical points of failure. A simple investment strategy is easier to stick with during times of stress. The pursuit of complexity is often a fool's errand, a way of feeling smart while making dumb decisions. As the great Leonardo da Vinci himself said, simplicity is the ultimate sophistication. The direct financial connection of this philosophy of simplicity is that it naturally leads to a more concentrated, high-conviction portfolio, which is historically how the greatest fortunes in investing have been built. The conventional wisdom peddled by much of the financial industry is diversification. Own a little bit of everything. This is promoted as a form of risk management. But as Buffett has famously said, wide diversification is only required when investors do not understand what they are doing. It is a protection against ignorance. He calls it diversification. If you have done the hard work, if you have stayed within your circle of competence and identified a handful of truly wonderful, simple, predictable businesses that are selling at attractive prices, then it makes no sense to dilute your best ideas with your 50th best idea. A portfolio of 10 to 20 businesses that you know inside and out is, for a knowledgeable investor, a far less risky proposition than a portfolio of 200 businesses that you barely understand. This concentration, when born of genuine understanding, is what creates the massive portfolio growth that leads to true financial freedom. This principle extends beyond asset allocation into executive decision-making. The greatest business leaders are often not the ones who chase every new trend, but the ones who focus their organization on a few core competencies, on doing a few things exceptionally well. They build deep, defensible moats around their core business, rather than spreading their capital and attention thinly across dozens of mediocre ventures. The discipline of simplicity, of saying no to the vast majority of opportunities in order to say a powerful yes to the few that truly matter, is the final and most profound connection between this simple rule and the creation of extraordinary, long-term wealth. You have made it to the end of this deep analysis, and in doing so you have done more than just watch another video about investing. You have invested your time and attention to acquire a powerful mental tool. This isn't just a piece of advice. It is a complete operating system for rational decision-making in the face of uncertainty. The principle of the circle of competence, the simple, final promise to never invest in a business you cannot understand, is now part of your intellectual arsenal. It is a shield that will protect you from the madness of crowds, a filter that will eliminate the most dangerous and speculative bets from your consideration, and an anchor that will give you the confidence to hold steady when the inevitable storms of market volatility arrive. You now possess the fundamental defensive strategy that has preserved and compounded capital for the greatest investor of all time. But a complete system requires more than just defense. A shield can protect you, but it cannot win the battle on its own. Understanding your circle of competence tells you where not to play. It defines your boundaries. It is the art of avoiding stupidity. But it does not tell you where, within those boundaries, the greatest opportunities lie. It does not tell you what to buy, or, just as importantly, when to buy it. Buffett's system is a network of interconnected mental models. The one you have just mastered is the foundation, the bedrock upon which all others are built. But there are other pieces to this map. There are models for valuing a business, for judging the quality of its management, and for understanding when the market is offering you a price that represents a true margin of safety. You have built the fortress walls, but now you must learn how to strategically deploy your forces from within that fortress. The video that is now appearing on your screen is not a random recommendation. It is the next logical step in this journey. It is the missing link, the piece that connects the defensive posture you have just learned with the offensive strategies that create truly exceptional returns. Think of what you have just learned as the lock on a vault protecting your wealth. The ideas in this next video are the key. It will take the foundation of understanding and build upon it, showing you how to translate that understanding into decisive, profitable action. The choice to click is not about watching another video. It is about deciding whether you are content with simply protecting what you have, or if you are ready to continue your ascent. It is a choice to move from being a cautious spectator to becoming an intelligent actor in the arena of wealth creation. The map is in front of you. The next step on the path is clear. Complete your mental arsenal, continue the journey,